Welcome back. Today we are going over Williams-Sonoma. This is a stock, I've been watching it for a long time. It's been on my watch list. I think by the end of this video, they're going to at least be on your watch list, but I've been too greedy with the price. I haven't bought any yet. Yeah, we'll talk about that, but I think it's a great company, and I actually hope the stock goes down so that I might be able to buy some, but let's get started. So first thing we're going to do, I'm going to go through the investor presentation, show you some of those highlights. I'll show you how it's a magic formula stock. Then I'm going to look through the financials, and after that do a discounted cash flow valuation, I think. Yeah, I think that's how I'm going to do it. Anyway, to start, like I said, here's the investor presentation, and this is Williams-Sonoma, but they also own all of these. The big one is Pottery Barn. Like, I knew who Williams-Sonoma was, but whenever I found out that they're also Pottery Barn, I was like, oh, this is a big deal, because this is to like take a page out of Peter Lynch's book. He found a lot of success by investing in companies that his wife loved, and this is definitely checks that box for me, right? I mean, I can't tell you how much time or money we've spent between Pottery Barn and Pottery Barn Kids, especially with the new baby. So these other ones, we don't do as much. I know of Williams-Sonoma. Actually, you know what? I say that. I think I have like a $300 pot in the kitchen from Williams-Sonoma. So spend money there too, apparently. That's their portfolio, their brand portfolio. Now, I just want to go through some of the financial highlights. The big thing is their growth on the e-commerce side. So, I think everybody thinks of Williams-Sonoma Pottery Barn as like a mall brand, and that's how I know them. But also, their e-commerce business is growing fast. I mean, just look at this growth here. Now, you'd expect this big jump up from COVID, and you're going to see that with almost every company, where 2020, I mean, look at that difference from 3.3 to 4.8. What is that? If I just do this up here in the calculator, 4.8 divided by 3.3, yeah, 45% increase in 1 year. That's wild. So the big thing is going to be, is that going to continue, or was this just a COVID spike that's going to come down? I mean, it looks like we got 2 years to back it up now where it's still grown, okay? So that's good. What else? There's some highlights. Look, I'm reminded of, I forget who said it. It was Peter Lynch or Warren Buffett or somebody that was like, take the amount of color pictures in an annual report and like just deduct value for each color picture in the report. And this is like breaking all those rules. Look how many colored pictures are here. But anyway, I won't talk about that. Let's see. Okay, financial outlook. This is what we care about, right? What do they think is going to happen with the finances? And we're going to do a much deeper dive, okay? If this is your first time watching, this is just kind of the basics, company overview, that sort of thing. Their earnings per share has grown pretty good, but like I said, the big spike was the COVID year, and most of that was from e-commerce, and then just revenue as well. All right, return on invested capital, another thing that we're going to look at, and this is a magic formula stock, so if you know anything about the magic formula stock, the return on invested capital is going to be pretty strong. And then look at this total shareholder returns compounded. The 3-year compounded rate is 24%, 5-year 21%. Compounding at 21.9 for 5 years is pretty strong. Watch this in the calculator. You do 1.219 raised to the fifth. So you'd be 2.7 times your money in 5 years at a 22% return, let's say. The other thing that's really neat, and we're going to dive into this as well, is these share repurchases. We're going to look at them on a quarterly basis to see a pattern, but it's good to see that they're returning value to shareholders. Just to highlight one more thing about these repurchases, look at this. They've returned $3.2 billion to shareholders over the last 5 years, okay? So their market cap today is $8 billion, okay? So just the shareholder return alone, 3.2 on today's market cap would be... is that the way to do it? Yeah, that's 40%. Okay, so if they do that in 5 years, I mean, you're making 40% on your money just from the shareholder returns if they duplicate that same thing. Now, that's a big if, right? That's the $1 million question, right? So anyway, what I want to do real quick, I'll just show you. These are the top 50 magic formula stocks, and you can see there's actually 3 stocks I own that are on this list. The three of them, and I've done, there might be more, but I've done videos on three of these. It's AtCore's one. I've done many videos on AtCore. You should check them out. Immersion's another one, kind of a smaller position, but I like the company, or I think it's a good bet, let's say. And then here's Williams-Sonoma as well. Okay, Magic Formula, if you know anything about that, it's the book next to Port Charlie's Almanac right there. The little book that beats the market. Basically, it's a formula that ranks the best value stocks currently, okay, and these are the top 50, just in alphabetical order. The way he does that is some combination of multiple on earnings and then a return on invested capital or return on asset, that sort of thing. All right, that's enough of the intro. Let's go into the financials. Okay, so I have every quarter going back to April 2008, and this is the quarter ending on that date. So anyway, just to start, this is revenue, and if you see this like pattern here, because this is every quarter, right? This jump is going to be the holiday season. You know, that's the whenever Black Friday, Christmas shopping, that sort of thing. It should be at least. Yeah, I mean, if you look, this $1 billion, is that right? Yeah, $1 billion quarter was the quarter ending January 31st. So that would include November, December, and January. So yes, that's the holiday season. So what you're going to see for most of this video is that I use a trailing 12 months because I just think that helps kind of give you a better average. If you use trailing 12 months on like a retailer, you're always counting at least one peak, but no more than one peak, right? So like if I'm doing trailing 12 months, any four that I highlight will include one of the big ones, but not more than one, okay? So like even if you start at one or you right before, okay, anyway, I don't need to explain that, right? So what I want to look at is pre-tax income, okay? And this is, oh man, look at that. Look at that jump. We were talking about the e-commerce jumping, and look, that's wild. Just, I mean, like, how do you judge a trend like this? Like, I mean, you're flat, you know, almost like on a logarithmic curve, and then you just have this huge step change. Now things are starting to come down, so you might be a little worried, like, how far is it going to drop, okay? But just to put this into perspective, like I say all the time that a decent, very crude estimate of fair value is to take the pre-tax income multiplied by 10. So, like, even if they were to drop, let's say, to $1 billion trailing 12 months of pre-tax income, that would mean rough valuation, $10 billion. So, I mean, I'm not going to do that on the calculator. 1 times 10 is 10, right? So they're actually undervalued. Even if they drop, this would be a big drop. This would be 40+%, right? If they drop to 8 at a very high level, that's kind of what is being priced in right now, I would say. I mean, that's really, like I said, it's very high level, crude estimate, but I would say that that's kind of what the market's expecting. You know, they're expecting future earnings to be around this range based on them selling pretty consistently around the $8 billion market cap, right? Okay, we're gonna do a real valuation later. What else do I want to look at? I don't need to see anything else from the income statement. I'm gonna look at debt and all that on the balance sheet. So the balance sheet, first thing I really like to look at is tangible assets. I like to look at tangible assets just because I feel like it's a better measurement. You don't count a lot of these funny assets or fudge factor assets like goodwill or intangible assets, stuff like that, okay? And the reason I get total tangible assets is to then do a pre-tax return on tangible assets. So pre-tax return on tangible assets, look, there's many ways to get to this metric I'm trying to show you, okay? This is a measurement of like how good a company is at making money on the assets it owns. And you can do return on invested capital, you can do pre-tax return on invested capital, you can do return on equity. I'll tell you my problems with those, okay? Really, return on equity, in my opinion, can be really manipulated by debt. So you can have like a company with very little equity because you have just as many liabilities as assets. So it looks like you got this tiny amount of equity and you get this huge return on equity, but in reality, it may not be sustainable because there's a lot of debt involved. Return on invested capital, I think, is decent, but I just think return on assets is more intuitive. And I do pre-tax just so that I always compare apples to apples. I just think it's easier to do that. But that's just my take, right? So the big thing is that even before this jump, they were making really good return on tangible assets. I mean, I would say double-digit return on assets is strong. And to be over 20 is really strong. I mean, now it's ridiculous. They're 30%. But just to put this into context too, what if they dropped all the way down to 20%? What would that be on their current tangible assets? Because, okay, so if you remember, their tangible assets were growing. Let me go back to dollars. So if they were to even drop back down to 20% on tangible assets, it would be 20% of $4.5 billion. So calculator again, 4.5 billion. I'm going to do 4,500. So times 0.2. I mean, that would be $900 million. So real quick, I'm going to go back to the income statement. So if you remember, I said, worst case, they could drop all the way back here. That's not really worst case if you look at it from a return on assets basis, right? Even if their return on assets went all the way back down, it would be in this 900 range, which would be right here. Okay, so that's interesting to me. Definitely will affect the valuation. Next, I want to go back to the balance sheet. I'm going to look at the debt to equity ratio. Do I even have that calculated? Yes, I do. Okay. Debt to equity, I'm going to put this as a ratio. So okay, here's your decimals. So basically they have $2 of debt for every dollar of equity. It's not ideal, I would say. You kind of want this graph going the other way. But there are some circumstances where this kind of makes sense. So for example, if a company is buying back a lot of shares, then they're expending assets, cash, to retire shares, so it could skew that number. And they really are. I mean, I'll show you the ordinary shares number right here, but we're going to look at it more in the cash flow statement. I mean, look at this share retirement since '08. I mean, even since, what is this, like 2012, they were at 100 million shares, and now you're getting close down to 60. So, I mean, if they continue at this rate, I mean, it's that alone will yield a good return, right? Free cash flow. This to me is one of the most important metrics. I'm going to use this to value the company. So what you can see though is that their free cash flows actually runs a little bit lower than their pre-tax income. This is common for companies it's common for most companies, but especially this is a trend for companies that have a high capital expenditures, that sort of thing. So it's a little concerning, but I've just factored into the valuation. That's why I'm going to use free cash flow to value the stock and not pre-tax income, right? Now, this general exponential, I mean, it's pretty nice though, right? If it continues on this, discounting the COVID peak, it's still up significantly since pre-COVID. Real quick, I did not adjust for stock-based compensation, but I usually think it's a good idea to look at that. So trailing 12 months, let's just say they're making $800 million on a yearly basis. Stock-based compensation on a quarterly basis, so this is quarterly, is like 25 million. So that's 100 million. Oh man, $100 million in stock-based compensation on a free cash flow of, what was it, 800? Wow, so that's 12.5%, right? Okay, well, I'll do it for you. 100 divided by 800, 12.5% of their free cash flow is stocks to the managers and other employees. Don't like that. All right, well, I'll just factor it in. So that 800 here that I'm going to assume whenever I do the DCF, I'm going to subtract 100 and assume 700 instead, okay? All right, so let's go to the discounted cash flow valuation sheet. Okay, so this is my DCF sheet. It's separate from the other valuation thing. I'll actually send you the DCF sheet for free. Just email me, and I'll send it to you. It's just an Excel sheet, right? Real quick, though, before we do this, that stock-based compensation thing's got me all worked up. I want to go look at insider ownership and see what the insiders are holding at Williams-Sonoma. So to do that, I'm here on the website openinsider.com. I will link this. You type in any ticker symbol and it tells you the recent transactions, okay? All right, red is bad, obviously, and I don't like seeing people sell shares. And I mean, the last filings were late last year, but still, I would rather see people buying shares and selling shares, right? Especially whenever they're being given shares and then selling them, not great. Man, it was going so good. I can't believe I didn't really look into this before, but that's why it was always on my watch list and I never pulled the trigger. Okay, let's go back to valuation. Okay, cash flow. I am going to say 700 million per year, growing at, it was pretty modest growth at, I'm just going to say like obviously it wasn't modest growth whenever you factor in COVID, but since then, if you remember from their little PowerPoint, it wasn't growing that much. So I'm just going to say like 4% or nah, we'll do 5%. Okay. And then discounted at like a standard 12%, let's say, would mean that the terminal value is 9.9 billion. So that would put fair value, I'll just ratio that to the current market cap, right? So it'd be 9.984 divided by 8.17, which is the current market cap, times the current share price. Fair value with this calculation would be 155. Okay. If you know me, I like to discount a little bit higher. Okay, first of all, if you did this, you probably want a big margin of safety, like 2/3. Which will be like 103. So I'll just do it times 2 divided by 3. Yeah, $103 per share would be, fair value with the margin of safety using these inputs. Okay. Using these inputs with a margin of safety of 67%. I prefer to do a discount rate of 15%. I just do a 15% discount rate actually because I've done it for so long with all my other stocks that way I can compare apples to apples and see which investment's better than another one, right? That's the real key, right? Because what you want to do is use the same discount rate. It doesn't matter what the discount rate is, but do the same discount rate with all of your available options, and then you compare your best ones, right? It has little to do with is 15% better than 12. What's important is that you do the same one for every stock, right? Okay, so I have fair value at $7 billion. So 7 divided by 8.17 times 127.25, 109. That worked out well. I've told a lot of people 110 is where I'm like have a alert triggered on my phone, but I don't think I would buy it until it got under 100. So like my margin of safety maybe 80%, so 87, so maybe below 90. So the growth's promising. I think that they do have a moat. Some concerns would be, okay, first off, from the financials, the debt to equity, so the debt's growing a little bit. The stock-based compensation is also a little bit of concern. And then the third one's more of a macro concern, and that's how tied Pottery Barn is to the housing market, right? Because when do people buy the most from something like Pottery Barn? It's whenever you move homes or you renovate homes. I don't know if y'all have ever moved homes or not, but of course, whatever furniture you had in the last house, it doesn't match the aesthetic of this one. So you got to buy new furniture. You got to do that's all of that. So anyway, yeah, I mean, it is going to stay on my watch list. I'll keep my alert probably at 110, and then I'll look at it closer if it starts dropping below 100. But right now, I feel more comfortable with my other stocks. So that's where I am. I hope you enjoyed the video. I hope you learned something. Like, subscribe. I'll see you next time.